Credit spread risk versus other risks. Have you ever wondered how credit spread risk stacks up against other risks in options trading? Let's break it down in a way that makes sense. Credit spread risk is a specific risk that comes into play when an investor sells and buys options of the same type, either calls or puts, on the same underlying asset but at different strike prices. This creates a net credit, which is the premium received. One of the key features of credit spreads is that they offer a defined risk-reward profile. This means you know your maximum potential loss and profit right from the start. The main risk here is that the price of the underlying asset moves against your position, leading to a loss that can reach the maximum defined amount. This maximum loss is calculated as the difference between the strike prices minus the net premium received. Now let's compare credit spread risk to other risks in stock trading and options. First, credit spreads have a defined risk. This is different from naked options or owning stocks outright, where you can face unlimited losses. With credit spreads, you know exactly how much you can lose at the outset. However, the profit potential is limited too. The maximum gain you can achieve is the net premium received when you set up the spread. This is generally less than what you could earn from outright option sales or owning stocks if the market moves in your favor. Another aspect to consider is early assignment risk. Since credit spreads involve short options, especially American-style options, there is a chance of early assignment. This is particularly true as expiration approaches or around dividend dates. Monitoring your positions closely is essential to avoid unexpected exercises that could impact your margin. Speaking of margin, credit spreads usually requiring lower margin than naked options. This is because your maximum loss is capped. The margin is calculated based on the difference between the strike prices minus the premium received, making it a more efficient use of capital. Even though the maximum loss is capped, sudden large losses can still occur if the price moves against you. Traders need to actively manage their positions to avoid margin calls or forced liquidations. When we look at other risks, stock ownership carries unlimited downside risk if the stock price drops significantly. Naked options can lead to potentially unlimited losses for naked calls and considerable losses for naked puts. Other spread strategies, like debit spreads, also have defined risks but requiring an upfront payment, unlike credit spreads which provide initial credit. Credit spreads are also affected by volatility risk. Changes in implied volatility can impact option premiums and the value of your position. Time decay is another factor. Credit spreads benefit from time decay as the short option loses value, similar to many other option strategies. In practical terms, credit spreads are often used to generate income while keeping risk under control. They are suitable for traders who expect limited movement or have a specific directional bias in the underlying stock. Effective risk management includes setting clear exit points, monitoring for early assignment risk, avoiding over-leveraging, and diversifying positions. Overall, credit spread risk is more controlled and limited compared to many other risks in stock and options trading. However, it still requires active management to handle assignment risk and margin considerations. Understanding these differences can help you make informed decisions in your trading journey.